Hey there, everyone. Welcome to my YouTube channel. My name is Ryan Schul, and today's project is all about financial market risk assessment. So I'm actually going to break this into 5 different parts. I'm going to have 5 different videos. They're all kind of interlinked and co-joined a little bit, but they're all going to be somewhat separate too. And I think this is very appropriate because of all the market volatility that we are witnessing right now. Certainly for the past couple of weeks. It is April 12th now, and for just about 2 weeks or so, we've had a lot of choppiness in the market, a lot of bouncing around, a lot of up and down because of Trump's tariffs. Mostly, that's what's driving everything right now, right? So there's a lot of uncertainty. There's a lot of unpredictability. And what does the market like? It does not like those types of things. It likes consistency and persistence, right? Anything that is predictable and measurable and quantifiable, the market loves it. If it's very volatile and random and nobody has any clue what's going on, the market punishes that, right? So we don't like these types of things. So I put together 5 code samples and I can take you through it all, okay? So I'll try to break it down and help you understand some of what's going on so you can make more intelligent, more informed decisions. But honestly, like day to day, does anybody really know what's going on in the market? No, nobody knows, right? And if they tell you they do, they're just lying to you and probably misrepresenting things. And then you get to a gray area where it's actually illegal. If you give somebody a guarantee in the stock market, you can't do that, right? You can't make promises because you don't know what's going to happen day to day, week to week, month to month, not even minute to minute. Like nobody can tell you what the price of Coca-Cola or Nike or Disney is going to be 1 minute from now. Nobody knows what that is, right? But we can try to understand historically what has happened and try to use that information to make predictions into the future. So I'm going to show you how to do that, okay? And the reasons we want to do this are obvious, I think, to try to protect yourself against losses, to make smarter investment decisions, perhaps meeting regulatory requirements, right? If you work for a publicly traded company, there could be a lot of regulations in your business, especially depending on which industry or which sector you're in. In pharma, there's a ton, and finance, there's a ton too. Improve capital allocation, right? How do you utilize your capital? How do you create more capital? There's 2 things you can do, right? You can create capital, which is building wealth, building cash flows, building assets, and you can destroy capital. There's capital creation and capital destruction. We want to create capital, right? We don't want to destroy it, but if you're not careful, you can lose a lot of money in the stock market. Okay, I think everybody knows that. Prepare for extreme events. This is called a black swan event because black swans are not very common, although they do exist, and sometimes you see them, and sometimes you'll see like crazy things happen in the market, but it's pretty rare, right? And also to boost investor confidence. So confidence for myself, confidence for yourself, so confidence for everybody. So I'm going to go ahead and import some historical stock price information right here, okay? And I'm going to pull this from this library right here, Yahoo Finance, and I'm going back in time 12 months, okay? So you can change this to be whatever you want. If you want this to be 3 months or 6 months, you can change that. Of course, you can change all the stock ticker symbols that you pull in. I'm going to go with this. This is mostly the S&P 500 with a couple baseline ETFs. This is the S&P 500, not ETF, but this is a good proxy for the market overall. This is the S&P 500. This is what the index, NASDAQ, and gold. This is gold right here, and I have VIX. VIX is volatility index too, just because, again, there's been a lot of movement, a lot of up and down in the past couple of weeks. So I hit Control Enter to run everything in the cell. Okay, you can see the data that's being imported here. It's pretty fast. 34 securities are done for 12 months and a couple of seconds. So pretty fast right there. Now we can start to do some analysis on this historical data, right? So we are going to require a confidence level of 95%. So 95% of the time, we are going to be correct in the measurement, the kind of calculation that we're doing here. This is a VaR calculation, so value at risk. I'm getting 1.36%. Control Enter to refresh the cell. Oh, that was from yesterday. Okay, I just refresh it now. So 0.85 now with the newly updated data. 0.85, and the CVaR is the expected potential shortfall past what the VaR is telling me, right? So the VaR is the value at risk. So I have 85, I can lose 85% of the value of this portfolio. So if I invest $1 million in this portfolio, I can lose, let's see, 850 bucks. I guess that's what that is, right? Or 8,500. Sorry, 8,500. Is that right? My eyes are pretty bad here. Let me just check this real quick. 0.085. Yeah. Times a million. I could have done this before and put that in my notes and then do that. Okay, so that is a little bit different too. 0.00000. Okay. Put that in there equals that times that. Okay. Yeah, 8,500. Okay. So let me make an update right here because this is changing just a little bit. 0.85. And CVaR was, what am I looking at? 1.62, 1.64. My eyes are getting bad. I need glasses. Okay. So 1.64%. And this is beyond what the CVaR is beyond what the value at risk is, right? So if we exceed this threshold, how much more can we lose? This is kind of like a black swan event. Very unusual, very rare, but it could happen. Okay, these things could happen. So we want to know, like, worst case scenario is probably this right here. If we exceed this scenario, this would really be the worst case scenario right there. Okay, if we exceed that, it's like run for the hills because the market is just collapsing, right? And you have to get out. So it shouldn't happen, but the worst case scenario is 0.085, so 8,500 if you have $1 million invested. And the worst possible scenario that we can envision here is negative 1.64. So that would be like 10,640, negative 1.0164 times that equals that times that, right? 16,400, right? That would be the worst. That would be the worst possible loss that we would see in Monday. Okay, so we can go ahead and create custom shocks per asset to the portfolio. We can put these into a simulation tool right here and then go ahead and run this. So Control Enter to run multi-asset shock at 95% confidence interval. Again, so we're 5%. We could exceed this VaR at 95%, but we're 5% in excess of that. That's very unlikely to happen, but again, it could happen. Anything could really happen in the market, right? We can't predict with absolute certainty, but we can have a pretty high degree of confidence here. 95% of the time, we will not lose more than 1.73 on the portfolio given these shocks, right? So again, we're looking at the S&P 500. This is, which one is this? Index, the NASDAQ, yes. And then we have we have gold too, so we're looking at gold. So moving on here, stress testing. And scenario analysis, shock scenario. Okay, so let me go ahead and run this. Control Enter to run. And this is looking at now again, if we have a 10% crash and this impacts our market, right? The entire or our entire portfolio, and the risk is systemic and then impacts the entire market. What is the 95% worst daily loss? So again, this 95% is pretty common. You see this a lot in business. So 95% confidence that we're not going to lose more than this. This would be the maximum stress test assumption. But again, it could go above that. 5% of the time, we could lose more than that of the portfolio, right? So here, the stress VaR in this scenario is getting to be a big number, 10.85. So this is 0.1085 times that equals that times that. So if you have $1 million portfolio, potentially you could lose, wait a second, is that point? I don't need the percent there. Sorry, that's why. So now we're feeling a bigger loss here, right? So over $100,000 potentially. But again, that's probably the worst case scenario. But once again, it's 95% confidence, right? So you actually could lose more than this if you had a big event in the market. If you had a big crash in the market, it could go above $100,000 loss in one single day. Now that's very unlikely, but that could happen. And in the market that we've seen in the past couple of weeks with all the volatility and all the uncertainty, I mean, I hope it calms down soon, but We just don't know. We just don't know what to expect here. But in this scenario, the stressed VaR, worst case scenario, you would lose a little bit over $100,000 on a $1 million portfolio. Now let's look at the VaR. Again, 95% confidence, and the CVaR, 95% confidence. When we run the cell, we get our returns there. Okay, we have the mean, standard deviation, the VaR at 95% confidence interval in the CVaR again. And let me produce a chart because I think personally a picture is worth 1,000 words. So let me run the chart and I get this return. Oh, this is the VIX right here. You see extreme volatility. This VIX index, finance, let me show you something here, finance.yahoo. This measures the volatility of the entire market, and uppercase thing there, whatever that's called, VIX. Okay, so Chicago Board of Trade manages this, and why did I not get the VIX? What happened here? Something went offline. Let me try it again. And you cannot invest directly in the VIX. It's just a index for measuring the volatility of the market. There are a couple ETFs that pretty much mimic the VIX, but you can't invest directly in that. Okay, so here we can see this was Friday, 37.56. If we go back in time, 5 days ago, so there's a big jump up, right? This is when the market was kind of like moving very erratically. That was back on, what was that, 410? It was a big jump, and then back to 4.8. There's some big movements there, kind of dropped off a little bit here by 4.9. And I like this, I like how Yahoo Finance shows you the returns when you click on the on the duration of time over here. So 1 month, it's up 39%. Very good, very good. 83%. Okay, so this is when Trump's tariffs started to take effect, and you see a lot of jumping around there. Big spikes, big mountain. Year to date, 116%. That's interesting. I didn't even know that. 1 year, 151%, and 5 years, 0%. Okay, so very interesting, right? So that is the volatility index. I show you that just because I like these charts right here, and I love how you can click on one element of the chart, and then you can turn on or turn off, and then you can zoom in and you can see all the details in between here. Again, this is showing a 30-day rolling volatility, and this one is spiking up to, what one is this? This is, let me get the mouse over there, INTC. Oh yeah, I've seen that before. So INTC, if I click off that, I can remove this and we can see more of the details there. And then this is Triple M. Okay, so Triple M had some big volatility. This one is CRM. So customer relationship management. I think that is Salesforce, CRM. Trying to zoom in to get this one, and then have one more that's kind of jumping up a little bit, kind of dominating the scene. Nike. Okay. So Nike has been pretty volatile as well. I think they have a lot of imports from all over the world, and it is going to seriously impact their business, right? If they're hit with 100% tariffs, and now all of a sudden all the Nike apparel and shoes start to cost 100% more than it did before, that's going to throw a wrench into the works. Okay, so now instead of looking at fixed shocks on a portfolio, we can actually do a number of shocks, right, and use a whole bunch of scenarios. So this would be more like a scenario analysis or simulation analysis, where you're looking at a bunch of different shocks to the system and testing different scenarios. I have 1,000 scenarios here, and then we can see cumulatively what kind of impact that has on the whole portfolio. So instead of one by one, we can do 1,000 pretty quick and pretty straightforward here. Okay, so this is running, and we should get the chart printed out in just a moment. And then, so that's actually scenario analysis, and then I'm going to do a simulation analysis using Monte Carlo simulation and show you a slightly different perspective, a different point of view from the scenario analysis. Okay, and if you like these kind of things, I have a couple videos that cater just to these topics. So just scenario analysis, just simulation analysis. If you like that kind of stuff, it's kind of cool, I think so. So here we have the simulated VaR. So the VaR overall, based on the simulation I just did, is going to show you the distribution of returns over here. We have some negative, we have some positive. It tends to be hovering just a little bit negative, with the mean VaR negative 0.77, so almost 1% negative, and that's what we can expect, right? Because there's been a lot of market choppiness, a lot of volatility in the past couple of weeks. If this continues, then there probably will be losses, right? There's going to be a lot of red showing up on people's charts for the next couple of weeks. I think that could change. That could change pretty quickly if these tariffs go away, but realistically, I don't think that's happening. I think they're here for the foreseeable future. Although Trump was wavering on that a little bit. The tariffs were here and then they're gone and then they came back. So I guess that could change. Okay, so here we have the Monte Carlo simulation. We just saw the scenario analysis above. This is the Monte Carlo simulation below. And here we have, again, the value at risk with the confidence interval. If I zoom into this chart right here, we can see the VaR, the CVaR, and then the distribution of returns over time with the best case scenario about 0.15 positive. So this guy in this case would make 15% on the portfolio. So if you invest $1 million, you just made $150,000. That's great. Congratulations. But more realistically, we are probably right about -5%. So we're probably losing 5,000. And over here, this is kind of an unlikely event, but still possible. We can lose 10%. This is 10%. So we could lose 100,000 on this portfolio in this scenario over here. Okay, so why are we doing all this? To look at the value at risk and the CVaR. Okay, this shows us we're trying to quantify the expected losses at any given confidence interval over a point in time. We're doing stress testing, trying to understand based on these models what is the impact to our portfolio, what could we potentially lose in the market. Monte Carlo simulation, scenario analysis. We saw that right before the Monte Carlo, and sharp Sortino ratios, okay? And another thing to consider is drawdown analysis. So one of my other videos, I talked specifically about drawdown analysis. This is from the high point in the portfolio until you lose some money and you reach a valley there or an end, and the portfolio starts to come back, okay? So we'll see an example of that in just a little bit. So keep an eye out for that. So that's it. That is financial market risk assessment, video number 1 of 5. I put together 5 in this series. So check it out, you guys, and give me some feedback. Hope you like it. And hopefully this was informative. Hopefully I can drop some knowledge on you and you can take this and profit from it. That's the whole point. That's the intention here. Okay. Thanks. I'm going to wrap it up and I'll see you guys in the next one. Bye.